right, so we talked about beginning basis in a partnership and the concept of inside and outside basis. So the partnership to a partner is an asset. So just like any other type of asset, the assets that we've talked about so far, that basis can change over time with additions or certain subtractions. So the thing about the basis to partners is and this is a big part of partnership taxation, is keeping a running tally of what a partner's basis is in their partnership interest. Because if the partner decides that they're going to sell their share of the partnership, we need to know what that basis is in order to calculate any gain or loss that they have on that. Also, anytime a partnership issues a distribution to partners, and that's where, not like a guaranteed payment, because that's a salary, not ordinary income, because that's simply the partner's share of the income that they're reporting, but if the partner receives actual cash from the partnership, that's taking out of their basis in the partnership, and how that distribution is taxed, whether it's taxed or not, depends upon what the partner's basis is in the partnership. Because remember, basis can't go below zero. So we need to it's really important to keep track of what each individual partner's basis is at all times in the partnership, because if we have any distributions, we have to determine how those distributions may be taxable or not. Also, if the partnership has a loss, the partner's basis in that partnership will determine whether or not the partner can actually take advantage of that loss in that current year. So if they don't have any basis in the partnership and the partnership experiences a loss, the partner is not going to get to take advantage of that loss until such time as they have basis in the partnership. So if the partnership has a loss, we need to know what that basis is to determine whether or not we can take that loss. If the partnership has a liquidation or a disposition of a partner's interest, then we need to know what that basis is. And again, anytime a partner receives a non-liquidating distribution, that's the scenario that I just introduced, where the partner is getting some cash out of the partnership or some other type of distribution. It could be property. Usually it's in the form of cash. Whenever they receive that, to determine whether or not that's a taxable event to the partner. So in order to keep track of what this basis is, we need to look at what items, what events occur that increase or decrease our basis in the partnership. And again, this is from a partner's standpoint. Okay, so from each individual partner is going to have their own running tally of what their basis is. So the partner's share of separately stated items either increases or decreases their basis. So remember that K1, if you imagine that K1 that we looked at, we've got our ordinary income in box 1, and then we've got all of those separately stated items on the K1. Each of those separately stated items increases or decreases basis. So if we have an income item, now remember the basis is going to be increased because we are now paying tax on something. So if we pay tax on an item of income from that partnership, we're now going to increase our basis in that partnership. So when we have interest income or dividend income, we're going to be paying tax. We're going to be reporting that on our individual tax return as a partner. That then is going to increase our basis. Anytime we have a deduction, though, that's then going to decrease our basis because we're getting a tax benefit from that. Also, our ordinary income or loss also affects that basis. So if we have ordinary income in that box 1, that's going to increase our basis in the partnership. If we have a loss in box 1, that's going to decrease our basis in the partnership. So it's important to know, in order to keep this running tally, we need to know every year what our beginning basis is in that partnership. And then we need to know all the items that would affect, either increase or decrease it as time went on during the year. And then we come to an ending basis in that partnership, which then is, that carries over to the next year, and that's going to be our beginning basis. So separately stated, even those separately stated items, even if they're non-deductible. So remember, partnerships can have like charitable contributions. The partnership itself makes a charitable contribution, and then each partner, based on their ownership percentage, gets to take advantage of that deduction. So if we make a $2,000, the partnership makes a $2,000 charitable contribution, and we have 2 partners that are 50-50, each of those partners can take a $1,000 charitable contribution on their Schedule A. Now, we also know that not everybody takes or uses the Schedule A, right? If it's more advantageous for individual taxpayers to use the standard deduction, then they would not use a Schedule A, which is for itemized deductions. So, but for our purposes, even if we don't actually get a tax benefit from that charitable contribution, we're still going to decrease our basis. So even if we didn't get that benefit, we did not file a Schedule A, we took the standard deduction instead, even though we were entitled to a $1,000 charitable contribution that flowed through on our K-1 from our partnership, we didn't use it because our standard deduction was more. That charitable contribution is still going to affect our basis. So, and here's kind of the reasoning behind that. So even tax-exempt items affect basis. So if these items did not increase or decrease a partner's basis, and again, we're talking about the individual partner's basis, so their outside basis, they will have a tax effect when the partnership interest is sold or disposed of. So that charitable contribution, we didn't take it on our tax return, we didn't get a tax benefit from it at that point, but it's still going to have a tax effect for us by lowering our basis. If a partner share tax-exempt interest is $500, that $500 should never be taxed. If the partner's basis does not increase by $500, the partnership basis would be $500 lower. So they're getting the tax benefit of that, even though it's going to affect the basis ultimately when they actually sell the partnership interest. When the interest is sold, $500 in additional gain will be recognized. So thus the tax-exempt interest income will effectively be taxed at that point. So even though it was tax-exempt, once they sell the partnership interest, it'll end up being taxed at that point. So, and I think they go through here, so we're going to talk about the items that affect our basis. In addition to these items affecting our basis, there is a specific order in which we apply them. So the first thing we do, basis is going to first be increased or decreased by adjustments except for losses. So ordinary income, all those separately stated items, we're gonna include all that in, but we're not gonna include any losses at this point. Then the adjustment is reduced by any money that was distributed. So if the partner received a payment from the partnership, that's money that's distributed. Or if they are no longer responsible for some liability within the partnership, that also would be considered a distribution. So that would be the second adjustment that we make to our basis. Third, the adjustment is then reduced by the basis of any property distributed. So in this case, it's cash or the release of liabilities. The third one is any property that is distributed. So like a truck or a building or something like that that's transferred from the partnership to the individual. So here is the kind of the calculation of that running tally. So our starting basis is whatever it is at the start, whatever we contributed originally to the partnership, that whole calculation, that whole discussion that we had at the beginning of the chapter, we start with that. Plus, again, if we provided any services, the fair market value of those services would be included. Any property contributed, any cash contributed, all of that. Plus, the basis of property contributions after formation. So partners will oftentimes continuously make contributions to the partnership. Maybe it's short on cash, and so what they have to do is they've got to get cash from somewhere else, their personal cash, or take out a loan personally, and then they contribute it to the partnership so that the partnership can continue its operations. If that happens and a partner contributes cash or some other type of property subsequent to its formation, that increases the partner's basis. The partner's share of any partnership ordinary income, so that box 1 on the K1, is added if it's a positive number. So if we have ordinary income, if it's a positive number, that gets added to increase our basis. Partner share of separately stated income or gain items. So dividend income, interest income, rental income, any of those income items that has its own separate box on that K1, we're going to add that in. Plus the partner's share of partnership liabilities. Remember, we talked about that in formation when we had a property that was contributed that had a liability attached to it. That liability then got spread between the partners. That liability, because the partner is now responsible for that liability in their share, that adds to their basis in the partnership. So these are items that add to basis. Then we get to the subtractions. We're going to subtract the basis of any property distributed. So anything you're taking out. So up above, it's anything you're putting into the partnership. Now it's anything you're withdrawing from the partnership. Cash or property, again, but not below 0. We can't go below 0. Next, the partner's share of any partnership ordinary loss. So if the partnership had a loss, that is going to decrease their basis, but again, it cannot go below 0. Then we're going to subtract the partner's share of separately stated loss or expense items. So that charitable contribution, that's an expense item. 179 expense, that's an expense item. Those things are listed separately on the K1. We're going to subtract those amounts. If there was a capital loss, short-term, long-term capital loss on that K1, that would then come into play as well. And then we're going to subtract the partner's release of any partnership liabilities. So if the partner, if you remember back when we started this chapter, we had a scenario where we had an individual who contributed a building that had a liability attached to it. That liability was released, so that partner was no longer responsible for the whole liability. That got spread out amongst the partners. Here we're talking about that partner, if you recall in this scenario, when they were released of that partnership liability, that reduced their beginning basis in the partnership. Well, even if that happens after original formation of a partnership, that is still going to reduce their basis in the partnership. So basis that remains is used for the determination of any deductible losses from the partnership. So let's take a look at an example here. We've got Allison. So beginning basis of $5,000 in a partnership. This is at the beginning of the year. So 2024. She receives $3,000 in cash distributions from the partnership. So now she's pulling, it's like a bank account. So she's got $5,000 in it at the beginning of the year. She takes $3,000 out of it. So now her bank account goes down, right? You can kind of think of it in those terms. Now her bank account is down to $2,000. Her share of income is $2,500. So again, think of this in terms of a bank account. So she started with $5,000. She took $3,000 out, but then another $2,500 was was deposited into the bank account. That's her distributive share of income. And then she's going to receive as well a land distribution that has a basis of $4,000. And remember, basis to the partnership is going to be the basis to the individual, basis in, basis out, whatever that basis is in each of those for the partner or for the partnership. Once it transfers, that basis stays the same. So she gets some land out of it, out of the partnership. The basis is $4,000. Fair market value is $10,000. Here's how we calculate her basis over the course of the year. And again, if you think of this in terms of, first off, it's an asset, but if you think of it in terms of, it's like a bank account, right? Some sort of asset account. We start with $5,000. We put in another $2,500. But then we take out cash of $3,000, and then we take out this land of $4,000. I know land's not cash, so it's a little different conceptually because you're not going to withdraw land from a bank account. But if you think of it in those terms, what happens? We go from $5,000 beginning basis to a year-end basis of $500. But it has to be calculated in that order. Okay, and remember, this year-end basis cannot go below zero. So it's at 500, that's fine. That means that next year, she's going to start out with a beginning basis of $500, right? And then we'll keep track of all of the transactions that happen throughout the year. So the K1 that we looked at before, this comes from that K1 that we looked at in an earlier section here. So here's the partnership basis. This individual had a $22,000 beginning basis in their partnership. On the K1, their share of the ordinary income was $60,540. That's what would have been in box 1. We're going to add these other separately stated items, income items, and then we subtract the separately stated expense items. So if you do all of that math, the ending basis is $71,595. Now, you will notice that the guaranteed payments, if we can, let's see, 14.2, I don't think they have it here. I'll have to go back to the other page in order to see it. We'll go ahead and go back to the other page. So this is the K1 that they're referencing here. So that's $60,450. That's where that's coming from. Guaranteed payments are $42,000. The guaranteed payments are not listed or not included in the basis calculation because the individual is paying tax on them when they file their return. So let me go back to the page that you're just at. I just wanted to reference that. So as they mention here, the guaranteed payments are not used in the basis calculation. Guaranteed payments do not have an impact on basis because the partner will recognize income from the guaranteed payment and they receive a payment for the exact same amount. So if they received the payment, that would reduce their income, or their basis. They're getting something out of the partnership, so that would reduce their basis, but they're turning around and paying tax on it. So what that does is it then increases their basis by the same amount. So we just don't even worry about it because it's just in and out. It nets to zero. So we're not going to include the guaranteed payments in this calculation. All right, so, excuse me. So that K1 did show the partner share of liabilities on that K1. I'm not going to jump back to it because then I have to walk all over the place. Most tax preparers will calculate basis but ignore the liability implications at that point. Usually we'll take those into account when the basis or when the partnership is sold. In most cases, the liabilities are considered only if the increase in basis is necessary in order to deduct a loss from the partnership. So we cannot deduct a loss if there is no basis. So the last thing we would do is see if we're down to zero basis, we would see if that partner has any liability that they're responsible for. And then we would take the basis out of that to apply it so that they can take the loss. The liability level of the partnership is consistently changing, because think about it. If it's like credit cards or something, they're constantly paying that off. Different types of loans, their loans are amortized over time. It's constantly changing with every liability payment. So it's kind of a nightmare to try and keep track of that on a consistent basis. Most of the time, the calculation is not necessary. So here we've got on that K1. I didn't point it out, but this is what it was showing as far as the liabilities go. We wouldn't take these into account in calculating basis unless we had a loss that was so big that we then had to dig into these liabilities in order to take that full loss. Okay, so these are the things I want you to take away from this section for the most part. I want you to kind of be familiar with all of these things that affect the increase and the decrease in a basis calculation for a partnership, as well as the order in which they have to be calculated. Okay, so that's the major thing here. All right.